Good morning, everyone. I see Ayush Khanna, moderator of today's webinar. Welcome you all on the behalf of our Standards of Valuation Board by ICAI. Today we have our Valuation Month in Session 16 and again, Energetic Sunday. We are going to cover purchase price allocation as a topic today and hope this is going to be really fruitful for you because we have our very talented speaker with us, CA Bhavik. Before going ahead with our session and the slides, I would request CA Hansraj sir, the chairman of Valuation Standards Board, to please give a welcome address to all the participants. Thank you. Over to you, sir.
Yeah, thank you, Ayushri, the co-chairperson in the board, Valuation Standard Board, CA Preeti Savla from Mumbai, the star speaker of the day, Bhavik Shah, and the moderator, Ayushri, and our team, Dimple from the Valuation Standard Board as an officer and tech team, and the participant one in all. You see, like any day to be started with, it has to be started with a great enthu. Same way, we have to start the day with a better best of the learning and gaining out of the system in a manner so that ultimately whatsoever the time spent with, it really feels like it's a value added time. On this valuation manthan, this is the 16th series which we started. Which we started, and today it is a 16th in the series. Naturally, in the process, we have learnt a lot from the starting from the regulatory mechanism. Wherever the regulation requires evaluation to be undertaken with by way of the different law of the land, and somewhere business and the commercial requirements, wherever one needs to understand the valuation mechanism or nitty-gritty. Today in the series will be our star speaker will be talking about the purchase price allocation. Naturally, in the system of the valuation, it really important. It carries a great value. How you allocate in the system of the valuation the purchase price, whatsoever is being added into the different activities or whatsoever the manner the allocation required to be. And I, on behalf of each one of you, and on my own behalf and on behalf of the co-chairperson, I welcome our guest speaker of the day, Bhavik Saji. On my own behalf and the on behalf of the my co-chairperson and on behalf of the board, welcome each and every participants. And hopefully that day will go a best of the learning. Naturally, the Sunday one feel like it's an easy day, but for professional, any day, any time is a full of energy. Any day, any time, it's a full of newer things to understand with great enthu. And same spirit goes with this board also. With this initial remarks, I welcome each one of you and hope this session Manthan series will continue to develop a greater popularity. Naturally, at a point of time, it has been joined by all 2000 members spread, not limiting to our country, but beyond the boundaries of the custom frontier of our country also. So that is the kind of valuation Manthan has gained a momentum. With this initial remarks, I'll request my Preeti Savla, the co-chairperson in this board, to share her key remarks for the better for the members and our team also. Thank you. Preeti, over to you.
Very respected Chairman, Valuation Standard Board and Director of RVO and Chairman of FRRB, C. Hansraj Chukji. Very young and dynamic speaker for the today's 16th session of Valuation Manthan, who is going to speak on purchase price, C. Bhavik Shah, and my dear young moderator, C. Ayushri, an entire team of office and all seniors and dear participants on this Sunday morning, 23rd July 23. Welcome all of you to this 16th series of Valuation Manthan. Friends, today is also a remarkable day because today is also the birth anniversary of our leader Bal Gangadhar Tilak and Pandit Chandrasekhar Azad, and also Himesh Reshammia's birthday and Taraskar Bandyopadhyay. So today is very auspicious, a remarkable day we can say. And I hope this Sunday, every Sunday, we are interacting with all of you, and this is really helpful to all of you. It is our endeavor to serve the best, to the entire fraternity of our profession. Any support or required, we are always there. If you have any suggestions to give, please feel free to reach out to us. With these words, once again, I welcome all of you and looking forward, all of you, a very happy Sunday with a great smile on your face. Thank you so much.
Thank you so much, ma'am, for your words and guidance. And thank you, Hansraj sir, as well, for giving me opportunity. And, every single word from your side means a lot for everyone, actually. Those who are not, directly contacting right now, we all can see each other, but every single word motivates all the participants present in this webinar. So with these words, I would like to introduce our speaker for today, the valuation professional, CA Bhavik Shah sir. So he is a partner with the Financial Advisory Services at Transaction Square LLP, an experience with more than 14 years of these valuation and related work. He was also a part of group by which was formed for Valuation Standards Board of ICI for drafting valuation standards notified by ICI. He has been a regular speaker at various seminars, study circles, and study courses at various stages as well, not only ICI, but also with Institute of Company Secretary of India. He has also authored an article, and we should be very proud of that fact, which was published in the Journal of Chamber of Tax Consults. There is much more to tell about you, sir, but with a short of time, we want to learn a lot from your side in today's webinar. So with these words, I would welcome you to the webinar, and please enhance all our knowledge with your words. Over to you, sir. Thank you.
Thank you, Ayushi. Thank you for your kind words, and thanks for a very nice introduction. Good morning, everyone. I must congratulate CA Hansraj Chugji and CA Preeti Savla for continuing this session, giving it back to the society in terms of arranging this session, speaking with the speakers, deciding on the topics. It's a great ask, and this has been done since 16 Sundays now, and it is remarkable. I must congratulate both of you, along with your tech team, along with the Valuation Standard Board team, and definitely the moderator, CA Ayushi. Preeti, you set the tone well, and I'm sure that participants on this Sunday are going to have some takeaways from this session. I will just share the screen, and once it is visible, let me know and we can start with the session.
Yes, it's visible.
So, as I said, I'm extremely honored to be invited to share some of my practical experience. Is my screen visible, guys?
Yes, sir.
It's moving, right?
Visible, Bhavi.
Okay. So I'm extremely honored basically to present this fairly complex topic of a PPA. So PPAs have been in existence in the old GAAP regime also under Ind AS 14. or AS14 as we may call it, wherein purchase method of accounting was required in case of a merger. However, it is gaining more importance, more prominence in the Ind AS regime. And as and when we are moving ahead, there are complex business acquisitions being structured in the current times. And that is the reason the PPAs are getting more and more prominence in the current Ind AS regime. So for the next 90 minutes or so, my endeavor is to take you through basically the principles of the Ind AS, such as what constitutes a business combination, what does comprise of a business, who as an appraiser can do a PP exercise, what are the characteristics of an intangible assets, what are the recognition criteria, and we will also touch upon and understand the principles of the WACC-VARA IRR analysis. We will also cover a case study to practically understand as to how do we perform a PP exercise. And lastly, what are the key credentials which needs to be undertaken when we are drafting a PPA report. So what is a purchase price allocation? A purchase price allocation is basically not defined anywhere in the Ind AS 103, but it is a practice to allocate the purchase consideration which has been paid to acquire an asset or a business in terms of the tangible and the intangible assets at an acquisition date. So technically, a residual purchase consideration in terms of anything which is remaining after allocating the purchase consideration will be allocated to a goodwill. And if it is a negative consideration, then it will be considered as a bargain purchase in the acquirer company's books of accounts. A PPA is required to be done under Ind AS 103, which is a business combination standard. And Ind AS 103 does not apply to a formation of a joint venture as well as acquisition of an asset or a group of assets that does not constitute a business. And as I said, it's a fairly complex process. It requires understanding of the business in detail, the prospective financial statements, and a deep domain knowledge to ensure that all aspects of the analysis have been factored in accurately. So everybody understands what are tangible assets. Basically, it comprises of a plant, machinery, land and building, working capital. But what are intangibles? Intangible assets are those assets which provides additional economic benefit to the owner of the assets, or to put it differently, they are primary contributors to the earning power of the enterprise. So this can comprise of brands, customer contracts, relationships. I will dwell into it more in the subsequent slides. But what are we trying to say over here? So suppose we have paid 100 rupees as a price to acquire a business. So first you allocate this 100 rupees in terms of the tangible assets, which let's say you have allocated 75 rupees towards acquisition or as a fair value of the tangible assets. The remaining 25 rupees is splitted among various intangibles. And let's say whatever you can identify and recognize, that is recognized, let's say 15 rupees is recognized, the balance is unidentifiable purchase consideration or unallocable purchase consideration, which is nothing but a goodwill. So let's see what is what comprises of a business combination, or what constitutes a business combination. So business combination is defined as an event where the acquirer obtains controls of one or more business structure based on a legal or tax consideration. So it can comprise basically of a merger, which is a legal merger where A entity is being merged with a B entity. It can be a combination of two entities where A and B are getting merged to form a new entity, which is a C. It can be a simple acquisition of a business. So let's say a business, a pharmaceutical or a brand which is acquired by the acquirer, and that brand is only transferred along with the formulation, that can comprise as an acquisition of the business by the acquirer. And it can also comprise when you are acquiring an equity stake in a company, and which is a majority of a stake where you obtain the control. So obtaining a control is of prime importance. And in the Ind AS 103, the control is defined basically that there has to be a power to govern the financial and operating policies of the entity from which it will obtain its benefits. The last one, which can come to my mind, is basically that the former owner obtains the control. So let's say it's a reverse acquisition where a private limited company, which is of a bigger size, getting merged with a public limited entity. Technically, the legal acquirer being the private limited company, and accounting acquirer will also be the same. So it is a reverse acquisition, and the PPA for that is governed by the Ind AS in terms of a reverse accounting. So there are technical implications to that, but we will cover this in the later slides. So let's understand what is a business. A business is nothing but it comprises of two things. There has to be an input and there has to be a processes which are applied to those inputs to have an ability to create an output. So on the screen, you can see that there is a chef which bakes the cake, and the inputs are the raw materials which are required to bake the cake, and which will create an ability to create the output. So output is not important, but it has an ability to create an output. But input and processes are prime importance to constitute a business. If it constitutes a business and there is a control which can be established, then only Ind AS 103 of business combination will apply to a particular transaction. So let's take an example or a case study, as you may call it. So there is this shipping warehouse company X, which provides shipping and storage services. And there is a company which is a consumer retail company called Y. And they plan to purchase several warehouses from X to use the warehouses to enhance its distribution system. Now, Y acquires the land and the warehouses from X, but does not plan to take over the warehousing contracts with third parties, employees, warehouse equipments, or information technology system. Now, will this constitute an acquisition of a business or an asset? So just repeating the case study, X is providing shipping storage service, Y is a consumer retail company, and Y is acquiring only the land and the warehouses from the X and not the warehousing contracts and everything. So as explained earlier, Y has acquired only the group of the assets, and it is not acquiring the related inputs and the processes capable of producing the outputs. And hence, it will be an asset acquisition and not classified as a business acquisition. Let's take one more case study. Let's say there is a manufacturing plant which is ready, but it has not commenced any commercial operations today. They are awaiting approvals. Everything is in place. The SOPs of the manufacturing plant are in place. And that manufacturing plant is being acquired by the company X in our example. Now that will qualify as a business combination because the manufacturing plant, along with the processes, along with the employees, are proposed to be transferred or proposed to be acquired by the company X, and that will qualify as a business combination as per the standard Ind AS 103. So basically, whatever questions you have, maybe you can just put it in the chat box, and I will ask the moderator to cover it in the end. Now let's come to who can carry out the PPA assignment. So in the Accounting and Financial Reporting Companies Act, a registered valuer can do. And there are other views also wherein an advisory services firm, which is not a registered valuer firm, any person can do. So there are two views, and my view is that basically the Ind AS is de facto deriving from Section 133 of the Companies Act, and hence a registered valuer should carry out the purchase price allocation exercise. I have practically seen that the advisory services firm, which are not a registered valuer, also carry out a purchase price allocation exercise. But this is the explanation that I have, that why do we follow this kind of view. Now let's look at what constitutes an intangible assets. So what are intangible assets basically? Intangible assets are assets which are identifiable, which have a characteristics of generating additional cash flow when put to use with the other tangible assets. Only such intangible assets which are measured reliably are accounted separately. Others are subsumed in the goodwill. Only such intangible assets which can be measured reliably can be accounted separately. Intangible assets also have a characteristics of being legally enforced and can be transferred without affecting the business. Now, how do we measure or identify intangible assets? So there are two measurement or identification criteria which is defined in the standard. One is a contractual criteria or a separable criteria. Now, if it's a contractual criteria, it has to arise from a contractual or a legal rights. Transferability or separability of a intangible is not relevant if you follow a contractual criteria. In a separable criteria, has to be capable of being transferred or divided or licensed. It can be rented or exchanged. So think of it from a customer relationship or a customer list. Can it be transferred? Can it be separated? It can be transferred without affecting the businesses in a greater way. It can be separated. It can be divided. Again, think of a property which can be rented on a lease basis. Can we say that leasehold rights of those properties are separable? The answer to that is yes, and it qualifies as an intangible asset. So intangible assets that do qualify for a separability criteria or a contractual or a legal criteria are subsumed into goodwill. So this is the flow chart as to how do we identify an intangible asset. As I said earlier, to identify the intangible assets, it has to qualify for a separate recognition. And first step is to determine, does the intangible asset meet the contractual or a legal criteria? If it qualifies in a contractual or a legal criteria, then you measure separately this intangible asset at a fair value. Now, does the if that answer to that question is no, then you check the separability criteria. In the separability criteria, you check for two things. One is there a restriction on the transfer or the sale of the asset? If it is yes, then you do not measure this separately. If the answer to that is no, then you measure the intangible asset separately. So intangible assets can be recognized only if it is probable that the expected future economic benefit will flow to the owner of the asset and can be measured reliably. So in the Ind AS, there is a carve-out basically for the assembled workforce. Now, in case of an assembled workforce, what happens is that it does not qualify the contractual or a legal criteria or a separable criteria. And why is that so? In case of an assembled workforce which is getting transferred, we don't have control over all the employees when the business is being transferred. And the company has an individual agreement with the employees and not the entire assembled workforce. The assembled workforce can basically go with the business, but you do not have a control in terms of acquiring that assembled workforce. So hence, it does not qualify the contractual or a legal criteria. Now, does it meet the separability criteria? An assembled workforce, though it will meet a separability criteria, but it cannot be sold or transferred without causing a disruption to the acquiree's business. And since it cannot be sold or transferred without causing a disruption to the acquiree's business, there is a specific carve-out in the Ind AS that the assembled workforce should not be recognized as a separate intangible asset. Now, practically, we calculate a cross charge when we are doing a valuation for the assembled workforce, and we apply when we are valuing an intangible under a multi-period excess earning method or something, which we will cover it later. But many a times clients have questioned us and let's say a software company is acquiring without any basically the main asset or the lead asset which they are trying to acquire is only the employees, and the advice is being sought whether this assembled workforce or the employees that we are acquiring as part of the business, can it be recognized separately in the books of accounts? The answer to that is no. It cannot be recognized separately in the books of accounts. There is a specific carve-out which in the index which mentions that the contractual and the separability criteria is not adhered to. Now, intangible assets can be bifurcated or can be bucketed as per the valuation standard into 5 different buckets. So the first bucket being a marketing related intangible. The marketing related intangible are intangibles. Think of it from, there are certain intangibles which differentiate from its competitors, maybe because of the trademark or a trade dress or some internet domain names. These are not exhaustive list which I have picked up, but there are many marketing related. But a brand or a logo or a service mark is something which will come to the mind when we look at the marketing related. So let's say if you are looking at an Apple, the brand of Apple carries a significant value as compared to an other unbranded or a less branded phone. That is how one will look at it, and whether there is a brand recall to this product or not. So a trademark can be registered. It cannot be registered trademark. It can be a B2B or a B2C. We will dwell into it as we go along the session. But it can be a contract. It can satisfy a contractual legal criteria, and hence it can be recognized as a separate intangible if it can be measured reliably. A trade dress basically, which has a unique color, shape, or a package design will qualify as a separable criteria. Internet domain names are certain names which are exclusively registered, and it has a contractual criteria attached to it. The next, trademark is something which we usually value when we are doing a purchase price allocation exercise. And it is always part of the discussion when we are trying to attempt this kind of an exercise. A customer related, think of it, these intangibles are developed in the due course of the business. So like I said, that there is a customer list. A customer list can be separated, it can be transferred to an other party, and there can be a value which can be attached to that customer list. So it qualifies as a separable criteria, not as a contractual legal criteria. However, it does not matter whether it qualifies as contractual or separable criteria. If it can be measured reliably, then it has to be assigned some value to it. There is an order or a production backlog. Now, whenever there is, so there can be customer contracts, there can be customer relationship, and there can be a production backlog. So let's say if I'm acquiring a business today on 23rd of July, there can be certain orders which are there in the pipeline, and there can be a serviceability. And if I'm in a turnkey project, I'm in a turnkey business, then technically I will have an order book of 1.5, maximum 2 years, where I will have a visibility that this is the order book and this will be serviced within a period of 2 years. That is something which we value using a order book backlog, and it has a contractual criteria. It is based on the contract usually, and it qualifies as a separate intangible. If there are customer contracts or wherein there is a contract which is available that you will supply this product to an X party for, let's say, 3 years, 5 years, which are long term in nature, not short term, maybe 6 months or so, that can be valued on a contractual legal criteria, which is a customer contract that we call it. And there can be a non-contractual customer relationship. Usually, we have seen that there is stickiness, or there are certain customers who are doing business with the companies, maybe for many years, and that can be valued separately as part of the customer relationship. There are artistic related, usually we, as a valuer appraisers, we don't come across much of it. But these are certain artistic related intangibles which can be valued, and they comprise of plays, operas, it's like books, magazines, musical works, pictures, photographs, AVV, audio video materials or something like that. So for an artistic related, let's consider, and one thing which comes to my mind is basically a McDonald artifact, which is a statue which is there on the bench. So if somebody wants to transfer, or if somebody wants to assign those to, let's say, a KFC, does it have a value? Obviously it has a value, and there are ways and means to value it again. So this can be considered as an artistic related intangible, which one can relate to. And artistic related can be non-contractual also, and which will definitely then qualify under a separable criteria. There are contract based, so these are driven mainly by the contracts, where there is a licensing arrangement between the parties. There are non-compete agreements. There are lease agreements, as I mentioned, that, and franchisee agreements, or there are supply contracts which are there. So these all will qualify as a contract-based intangible assets. And lastly, there are technology-based, which are driven more by the proprietary of the existing companies. It can be in the form of patented or unpatented technology. If it's a patented, it will qualify as a contractual criteria. If it's unpatented, it's separable. There are formulas, let's say, for a pharma company, a formula of making a drug is something which is very, which has a high value and which is a key intangible when you are doing a purchase price allocation. Or there are trade secrets such as recipes, processes, maybe for a baker, or let's say for a Badshah masala, or let's say a Wibs. When I say a baker, the process of making the fluffy breads is a secret formula or a recipe which is available with the company, which is not available with all the competitors, and they have uniqueness in terms of the Wibs bread and in terms of the Britannia bread. If I have to compare, though Wibs is more local, available in Maharashtra and many of them, or maybe Mumbai, the dominance is more in Mumbai, but Britannia is available, or it's geographically present. So there are trade secrets which are there, and it can be separately recognized and valued separately. Let's say a database. A database will be valuable for a software entity, which where the processes are more relied on these kind of databases. So in a nutshell, the point which I'm trying to say is that whether an intangible is classified as a technology or a contract, the two key things to assess is whether it is satisfies a contractual or separable criteria, and whether it can be measured reliably. If it can be measured reliably, then only it will have some value in the books of the acquirer. So having said this, let's come to what are the typical steps in the acquisition date. Moderator, am I audible? Because I'm getting a signal that my connection is weak. Okay. Hello. Yeah. So you have to first identify the acquirer and the acquisition date. The acquisition date is of prime importance, and to identify who is the legal acquirer, who is the accounting acquirer. As I said, in cases of a reverse merger, this becomes a little tricky, and that is the first step that we need to do. You need to analyze the information which is available in a share holders agreement or in a BTA. A BTA will be there in case of a business acquisition. In case of an equity acquisition, it will be through a SHA, as we may call it. The next step is to identify a purchase consideration. Now, this is a little bit a tricky step because we will dwell into it again in the subsequent slides. But just to give you a flavor over here, many a times there are closing adjustments which are there, and one needs to be cognizant about it that as per the BTA, at the time of closing, what adjustments need to be taken care of to determine a correct and a fair purchase consideration. Because if we make a mistake at this step, the overall the goodwill or a bargain purchase that we are trying to achieve through this exercise might have an impact. You evaluate the prospective financial information in the appraisals language. We call it a deal model. What is a deal model? A deal model is something which we determine at the time of acquiring the business or investing in this company as to what kind of cash flows which we can anticipate from acquisition of this business. Evaluate the IRR based on the prospective financial information. The next step is to recognize and measure tangible assets at a fair value. Now, usually a securities and a financial asset valuer cannot determine the fair value of the tangible assets. There are technical purchase price allocation report. The IBBI rule says that there has to be a check and balance which a valuer has to adopt even when you are relying on the work of the expert. So it is necessary to check for the accuracy, to check for the steps which a tangible asset valuer has adopted when you are doing a purchase price allocation exercise as a whole and issuing a report under a purchase price allocation. The next step is to recognize and measure intangible assets. We already dwelled into it at what are intangible assets to value it. We will dwell into it in the subsequent slides. You recognize, so whatever remains is a goodwill or a bargain purchase. It's and the second last step is to analyze the WACC, VARA, and the IRR analysis. Why it is important, we will come to it. And the last step is to prepare a PPA report. So coming to what is the acquisition date. So let me take a simple example over here. A BTA is entered today, and let's say the consideration is being transferred and the risk and rewards of the business are transferred 1 month down the line. Or let's say, for that matter, 1st of August. The standard is very clear that when the legal transfer of the consideration takes place and the acquirer assumes the assets and the liabilities being transferred, that is the date of acquisition. So 1st August in my example will be the acquisition date and not the signing of the BTA. Many of them will have questions. Basically, just put it on the chat box because now the presentation is going to take a flight in terms of the academic knowledge.
Sure, sir. I'll just post it in the chat box if we have any questions. Till now, we don't have any questions.
Right.
Yeah.
What will be the acquisition cost? So let's say when we are trying to acquire the professional cost to acquire the business of 10%, and let's say the acquisition price is 100. Whether the 10 rupees will be part of the acquisition cost or not. So this slide is basically whether the expenses or acquisition related cost will form part of a purchase consideration or not. So in the example which I'm trying to give you, 100 rupees is the business consideration which I'm trying to pay to acquire an asset or a business. 10 rupees is the acquisition related cost in terms of the diligence, in terms of drafting of the legal fees for drafting of SHAs and everything, whether the purchase consideration will be 110 or 100. The answer is that it should be 100. The 10 rupees has to be expensed out by the acquirer. It cannot form part of the purchase consideration. Now coming to the determination of the purchase consideration. And as I mentioned earlier also, that purchase consideration determination is of prime importance. Usually we have seen cases where there are deferred consideration as well as contingent consideration. Now, what do we mean by deferred consideration? Deferred consideration is basically, I'm trying to pay 100 rupees, but I have deferred. 50 is paid upfront, 50 is paid, let's say, 1 year down the line. That is something called as deferred consideration. There is no change in the consideration that is going to happen. It is just that the timing of the cash flows is spread out. What is a contingent consideration? In a normal parlance, contingent consideration is dependent on an happening of an event. So it can be either linked to, let's say, if a drug trial is being undertaken, then achieving of, let's say, a stage 2 trial or a stage 3 trial, and I will part out some amount. That can be one of the contingent consideration examples that I can think of. Or maybe if we are in a FMCG category and the acquirer or the seller is banging upon that we are going to come out with, or we are going to launch 5 different products in this timeline, then some consideration can be linked to dependency on bringing out or launching of these products in a particular timeline. It can be also linked to financial metrics like revenue or EBITDA achievability. How do we value it? For a purpose of valuation, there are methods like probability weighted expected realization method or an OPM, as we may call it, which is a complex method, like you have to do a Monte Carlo simulation and do that 10,000 or 50,000 runs to determine what is the value of that contingent consideration when you are determining a PC. But not getting into it right now. Usually, many cases we deal across are not straightforward in terms of the purchase consideration, and we see an element of a deferred or a contingent consideration as part of the PC. What are indemnification assets and liabilities? Many a times what happens is that in terms of when I'm trying to acquire a business or when I'm trying to acquire an entity, there are tax cases or litigations which are going on, and the seller may indemnify those liabilities, that if it pops up, I will be liable to pay this. Or there are assets which are, let's say you have paid some amount as part of the protest with the income, you have deposited that amount, and those basically, because the seller is assuming the liability of, so let's say income tax case is of 100, and as a deposit you have deposited 25 rupees. So that 25 rupees will become an indemnified asset, which in an acquirer's parlance, it is an asset as well as a liability, and it should not affect your purchase consideration. I have tried and covered examples to give you a brief idea as to what I'm trying to say over here. But the first illustration is to cover the difference between the contingent consideration and indemnification assets. So the first case is where a retention bonus is paid to a key managerial person of the acquiring if they continue in service for 2 years after acquisition. Now, think of this from a perspective where the promoter of the entity is going to continue in service for 2 years after acquisition, and there is a retention bonus which will be paid to him. Basically, will it be qualified as part of PC? And if it qualifies as part of PC, will it be a contingent or consideration, or it will qualify as an indemnification asset? The answer to both is no, because this is something which is not paid to acquire the business. It is paid basically to a key managerial person for the smooth functioning of the business, and it will not form part of the PC. Again, it is very intuitive that it does not form part of an indemnification asset also. The second example is the adjustment to the consideration depending on the future production capacity. This is obviously a contingent consideration. If there is an earn-out agreement, like I said, that on achieving of the EBITDA, consideration of X will be paid. On achieving of 20% more than the EBITDA, consideration of X plus something will be paid. Again, it will be a contingent consideration. There is a lawsuit which is there, and if there is any reimbursement which are required, it will be paid. Again, it will qualify as an indemnification asset. It will not be a contingent consideration. And the last one, which we already discussed, if there is a reimbursement of uncertain tax positions, then again, it will be an indemnification asset or a liability as the case may be. Let's take two case studies over here. So the first case study is that there is a cash consideration of 1,700 which is being paid, and there is a deferred consideration of 1,000. And this 1,000, so you have to look at, I'll just put the pointer. Okay. So when there is a, so this 1,000 is a deferred consideration which needs to be paid basically. I'm getting one message that there is some network issue. Is that so?
Yes, sir. In between, your voice is somehow glitching.
Just give me a moment. Record. Is it better? Yes, is it better now?
Yes.
Okay.
Yes, sir.
Let me know if there is any difficulty.
Okay.
Okay, so coming to the case study again, there is a cash consideration and upfront consideration of 1,700 million. And the point is that and there is a deferred consideration of 1,000. And this 1,000 is spread across 3 installments. So March 23, March 24, and March 25. So what we are trying to do to determine the purchase consideration today at the date of acquisition, we discount it for the period of months at a rate of discounting. Usually we take a risk-free rate plus a credit spread of the acquirer to discount it. I have seen practitioners adopting a risk-free rate, some other rate also, but this is a practice that we follow. We determine the present value, and this 110, which is the present value of the total consideration of 1,000 to be paid in the future installment, is part of PC, which is 2510, which is the summation of 1,700 and 810. Now, again, here in this example, I have tried to cover what are indemnification assets and liabilities. There is an EPCG claim liability of around 14 million, and there is a FD lien on this under some scheme, which is around 39 million. So the total asset is 25 million, which does not belong to the acquirer. So what will happen is that these assets are not forming part of the PC. Again, against this asset, a corresponding liability will have to be created and the enterprise value of the business remains the same. If it was a liability, a corresponding asset will have to be created by the acquirer, because this is something which is going to be recovered from the acquiree as part of the consideration. So there will be a corresponding asset as well as a liability which will be sitting in the books of accounts on day zero. Let's look at another case study. So acquisition has acquired, so there is an acquisition of 100% target from its shareholders, and the acquisition is pursuant to an SPA, and the acquisition is split into two parts. 60% is a cash consideration acquisition, and subsequently there will be an amalgamation of the entity with the acquirer entity. So in this case, how do we determine a purchase consideration? And in the SPA, there was one line which was mentioned that in the event the proposed amalgamation is not consummated, because amalgamation is subject to many approvals from the creditors as well as SEBI, and if it's a listed company, and NCLT, the acquirer shall acquire the balance 40% at the same price paid for the cash consideration. So in this example, how did we determine the PC? Is that we considered the 60% cash consideration of 2,700 million. This is a straightforward thing. Now the shares that were proposed to be issued of the target entity, that multiplied by whatever was the market price, that we considered to determine the purchase consideration or determine the equity value. Now, mind you, this is an equity value which we are getting. What will be the business enterprise value? You will have to make adjustments for the net debt. So in this example, it is 100, and that is how we determine the enterprise value of 4,520 million. Now, let's look at what are the methods of valuing the intangible assets. So we have determined the PC. Again, as I said, the next step is to basically give a fair value or determine the fair valuation of the tangible assets. But this being not part of the scope for SFA valuers, I'm not covering that. But usually we do a test check when we look at the valuation report of the tangible assets also. And then the very next step is to determine the valuation of an intangible assets that we have identified and which can be recognized. So like business valuation, again, intangible assets has three primary approaches: a market approach, income approach, and a cost approach. And the market approach, there is a comparable transaction method. Now think of it from a perspective that intangible assets are not traded in the market. If they are traded in the market, you don't get data to compare. And many a times, I would have not seen that this approach being commonly used because of the want of the data and the availability of the data. It is usually used for valuing maybe internet domain names, where a comparable website name as what rate it was transferred. Again, adjusting for qualitative adjustments to use this, or maybe you can use in case of a pharma industry when a brand is technically transferred as to at what multiple. But again, it requires qualitative adjustment in terms of the ranking of the brand which was transferred, the presence of the brand, and what is our subject brand. So many a times, many qualitative adjustments or factors will play a role when we are determining or when we are adopting this market approach to determine the value of a particular intangible. So as I mentioned, that this is not commonly used. Coming to the cost approach first and then delving into income approach. Cost approach, what do we mean by a cost approach? Cost approach comprises of two things. It's a reproduction cost method or a replacement cost method. Now think of it basically that if you want to value an internally generated software, and the company has developed this software internally, how do you value it? It is usually valued using that what is the kind of cost which will be required to reproduce or replace this software with an equivalent utility or a function. Now, when you are adopting this cost approach, again, it is seldom used. It is used mainly for assembled workforce. It can also be used for valuing a software. But the main fact is that it does not consider the earnings generating ability of the asset. And that is the reason that this is not widely used method by the practitioners, and it is used mainly for internally generated softwares or something like that. And in case of a replacement cost method, what are we trying to value is that if I have to create an exact or a similar utility or a function of this product, what is the cost that I will have to incur to recreate of equivalent utility? In terms of the reproduction cost, the reproduction cost will be an exact replica of the software which will be required to be incurred, but one has to account for technological obsolescence. So let's say our software is 5 years old, then one will have to account for that, and while using this method. Now, coming to the income approach. In the income approach, there are many methods, and I'm sure everybody as a practitioner would have come across in their day-to-day dealings. The first one and the foremost one being the multi-period excess earning method, a relief from royalty method, which is usually used for brands and technical know-how, or a with-without method. The last two methods, the distributor and the greenfield method, is something which is seldom used. A distributor method, again, I have seen practically being implemented, but in my experience, I have never come across a greenfield method being adopted by any of the valuers. These are preferred approaches, basically, which are considered when for valuation of intangible assets, and rightly so, because it considers the earnings generating ability of a particular asset. So what do we mean by a relief from royalty method? A relief from royalty method, the thesis or the premise of RFR, as we may call it, is that if an asset, a legal asset, is being given on an hypothetical basis to a third party, what is the cost savings that will happen if I own the asset? So it is a question of buy versus build. If I own the asset, what is the cost savings that I will have saved by owning this asset, apart from leasing this asset from a third party? So ideally, this is used for valuation of brands, trademarks, technology, and know-how. What are the steps to do this? You estimate the cost savings based on the hypothetical royalty payment, and this has to be on a net of tax basis. You discount the estimated cost savings to the present value, and you apply a tax benefit to the present value of the cash flows. Now, the important question or the important considerations when you are using a RFR method will depend. There are two things basically. How do you determine the royalty rate? So there are many databases which are available, and these are all paid databases such as Merger Market, Royalty Stats, Markables, and Royalty Source. This is something which we generally use. Many times we also do benchmarking studies, or we look at SEC filings. And the second is to determine whether these are definite brands or definite or an indefinite brand. So we look at the longevity of the brands. We look at whether it's a B2B or a B2C brand. Usually a B2B brand will have a lower royalty rate as compared to a B2C brand because of the recall value. Whether there is any exclusivity in terms of the geography whether it's a single brand or a multi-brand. All these things will play an important role when you are valuing a brand through a RFR method. Again, when we are valuing a brand, we will also adjust for a marketing expense which needs to be incurred or which is saved if it is forming part of the royalty. We will dwell into it once we look at a practical example as to how RFR is implemented. But these are the broad steps as to how an RFR method is adopted and what are the things that needs to be taken care of when you are adopting a relief from royalty method. The second, and this is usually the most important one, the multi-period excess earning method. Usually in the valuer's parlance, it is called as mean. And this is a variant of a discounted cash flow model only. Think of it that when you are valuing a company using a DCF method, you are valuing the cash flows of the company. The cash flows of the company comprises of all the intangibles and the tangible assets put to use to determine that kind of an EBITDA or an EBIT margin for a business. Now, what we are trying to do, we are trying to dissect the cash flows as to what is attributable to a particular intangible. And this is the method that we have under the armor of the valuers, which can be used. And how do we apply? And usually this method is applied for valuing the lead intangible assets. So and many a times I would have seen that for valuing customer relationship being a lead intangible asset, then we apply multi-period excess earning method. What are the steps to apply this method? It's you start with the EBIT, you reduce the taxes, you determine the free cash flows, and these free cash flows are before contributory asset charge. So as I mentioned earlier, the EBIT is pertaining to the company or to the business in particular. There are tangible assets which has been put to use to generate this kind of an EBIT. From this, we reduce the contributory asset charge, which is applicable to tangible as well as other intangible assets which has played a role. So a question will come to our mind as to why do you reduce a contributory asset charge for the other intangible assets? So let's say there are two assets which are being valued, a brand and a customer relationship, and it's a B2B business. So brand is not a lead asset and the customer relationship is a lead asset. While I'm valuing customer relationship, does this EBIT include certain profitability element or certain economic benefits which are generated by that brand? The answer to that is yes. The point which we are trying to deliver over here is that we are trying to determine what is the value of customer relationship. So for that, we reduce the contributory asset charge for the other assets in our example of brand also to determine what are the earnings or the cash flows attributable to a customer relationship. So you arrive at the free cash flows after CAT. We will deal into all of this in terms of the case study which I have prepared. This may sound a little bit confusing, but I think everything will be answered when we go through the case study. You apply a discount rate which is commensurate with the intangible asset. You arrive at the present value of the free cash flows. You add the TAP benefit if it is applicable, and you determine the fair value of the intangible asset to determine what is the value of the intangible asset in our example of customer relationship. Now, the last one being the with and without method. Now, think of it from a perspective that if there is and usually with and without method, I have used for valuing non-compete agreements, and it's a contractual agreement which as part of the business acquisition it will happen, or it can be also used to value customer relationship or a distribution network. So let's take an example of a customer relationship again. If we are valuing a customer relationship using a with and without method, And if there is an customer relationship, what will be the cash flows with relationship and without relationship? The basic assumption being that other things being equal. So working capital, the uh, plant and machinery, everything is available with the company. Only thing which is not available is a relationship with the customers. So this is the basic premise when you are adopting this method. So maybe somebody will appreciate more if I take an example of a non-compete. If there is a non-compete, what will be the cash flows of the entity or a business? If there is no non-compete agreement with the erstwhile promoters or the seller of the business, the seller can compete or get into the market and take away some customers, uh, and which will tantamount to a loss in terms of the cash flows, in terms of the revenue or my earnings capability. It may also tantamount that I will have to do a higher marketing spend to retain those customers. That also needs to be adopted in terms of a without non-compete business when you are valuing a relationship or a non-compete arrangement. But the principal premise or the assumption is that the other things are available. So in case of a non-compete, you assume that the working capital as well as the tangible assets are at display, are available to be employed to generate that kind of a margin. So you develop the cash flows under a with scenario, you develop the cash flows under a without scenario. You calculate the difference between the free cash flows under the with and the without scenario to arrive at the incremental cash flows. These incremental cash flows are adjusted at a commensurate risk-adjusted discount rate but applicable to a particular intangible asset. You apply a TAP benefit. Now, when you are valuing a non-compete agreement, one needs to also consider whether there is any weightages attached to the probability of the competition. So we look at whether there is an ability of the seller or willingness of the seller to compete in this kind of a business. So many a times we have seen that as per the part of the agreement, the seller has to, for the smooth transitioning of the business, the seller will be associated with the company on a salaried basis for 2 years or maybe 3 years time. And the non-compete is for 5 years, let's say. So technically what will happen that the non-compete will not have material value over here because the seller will be associated for 3 years with the company. So the risk of seller competing is extremely low, and that is only applicable for a period of 2 years, which is the outer period of the 2 years. And one also needs to understand that for the first 3 years, if you are in the business, then might as well you would have covered that kind of a ground. And whether the seller enters into a competition because of his knowledge about the business, knowledge about the consumers, it might not be extremely detrimental to the cash flows of the business also. So in that case, the non-compete will be given an extremely low valuation. But as I said, it is a subjective thing and one needs to consider or one needs to assess as to what is the probability of the competition that you are determining. Again, one thing to note in terms of the non-compete, when you are valuing non-compete, the life of the non-compete is restricted to the contractual life. So if it's a 3-year non-compete, it has to be a period of 3 years that you will value. For a customer relationship can have a life, the economic life of maybe 5 years, but you can value maybe for 7 years, 10 years also. But for a non-compete, the life has to be restricted to the contractual life of the agreement. So I have been speaking about TAP, that you add the TAP benefit when you arrive at the present value of the cash flows. Now, what do we mean by TAP? So it is tax amortization benefit. It's a hypothetical premise. So think of it that whenever you buy an asset, once you capitalize it, it's a tax shield that is available to you, to the acquirer of this asset. And this is this is the tax shield that we are talking about when I mean that you have to add the benefit of the tab. Now, tab is extremely contentious issue in Indian parlance. Uh, so, so let's take an example that if I'm acquiring a business and if I'm acquiring an equity, in an equity purchase, a tax amortization benefit will not be available. A step up is not allowed as per the tax laws. And though Ind AS or the accounting principles are very clear that a tab has to be applied if a territory in which the asset is there, the step up of the tax is available. But in an equity purchase, we have seen cases or that the auditors have questioned the allowability of the tab. And from a practical perspective, we have not considered tab as part of our valuation excess report, with a caveat saying that a step up will not be allowed in the income tax. And that is the reason that a tab has not been considered. But think of it from a business acquisition through a slump purchase. In that case, a step up is allowed because the tax books allow recognizing the fair value of the intangibles. And in that case, we have gone ahead and taken a tab benefit applicable to a intangible asset that has been valued. So one needs to be extremely cautious when you are determining or when you are putting a tab factor. Tab factor generally varies in Indian context because we follow a WDV method of method from the tax perspective, and at a 25% rate. Tab factor is usually in the range of 18 to 22%. So technically what we are trying to say, if 100 rupees is the present value of the cash flow, you are adding 20 rupees particularly and determining 120 rupees as a value of an intangible asset. So if it is not allowed, it definitely impacts the goodwill or the bargain purchase number. So one needs to be extremely clear as to whether this has to be considered when you are valuing an intangible asset or not. One thing which I want to again highlight is that it is applied only under income approach and not under a market or a cost approach. And why that's so? Because in a market approach, when you are looking at a multiple or a transaction multiple, basically, this embeds the tab benefit which is there. And that is the reason you don't consider the tab benefit when you are applying a market or a cost approach. Tab is asset specific, basically. So in certain jurisdiction, it is not allowed, as I mentioned earlier, and hence it should not be applied. It is again asset specific. So if a brand is registered in India, though the cash flows are determined in US or maybe other geographies, the Indian jurisdiction should be applicable or should be evaluated when you are determining whether a tab applicability should be there or not. And the last thing which I want to highlight is what is the discount rate that you should consider. Basically, the discount rate that we usually consider is the intangible specific discount rate when we are determining the step-up benefit applicable to a particular intangible. I have seen practitioners using a weighted average cost of capital also, which is a single rate of discount to determine the tab benefit. But we feel that the discount rate has to be commensurate with the intangible asset that we are valuing, and hence we apply that discount rate. Again, it does not materially change the answer, but I have seen both the practices being adopted in the practical world. The next important thing is what is the economic life of the intangible asset that needs to be considered. And I'm sure that as accountants, we appreciate or we understand what is the difference between the economic and the accounting life. And in the economic life of an intangible asset is a little tricky thing to be determined. There is a lot of subjectivity. There is no thumb rule which is there as to how one can consider the economic life of a relationship or a brand or XYZ asset. But it's quite subjective. And as I mentioned, that for a brand, you have to see that whether an indefinite life can be considered or a definite life period has to be considered based on the various subjective factors or qualitative factors. Uh, there are competitive forces which will play an important role in determining the economic life if the competition is up to speed, like ChatGPT coming in, uh, and other AI tools coming in, then the life of the intangibles will be shrinking because there is continuous evaluation which is happening in the technology space, and the rate of the technological space is much faster, and the old intangible assets will deplete at a faster rate. If there are any legal, regulatory, or contractual limitation, so let's take an example. If it's a patented drug, basically, then and this drug is still not off patent and there is a 4-year life to it, then technically one may consider economic life of 4 years because there will be no competition unless and until there are chances that a different drug with a higher utility or higher efficacy is developed in the market or is being developed in the market, and there is a success ratio which is prevalent to it. One also needs to look at the attrition pattern. This attrition pattern is mainly from valuing the customer relationship when you determine the economic life of a customer relationship. Uh, Usually, we look at the historical patterns, whether there is a constant loss of uh, customers or there is a variable loss of the customers, which is happening. We look at 5-7 years data. Many a times what happens is that we don't have visibility or we don't have the historical data for so many years. Then we restrict our this thing to discussions with the management and a 3-year data to determine as to what should be the life of the relationship or that should be considered. But it is not an easy exercise. It requires judgment. It is usually challenged. But in my experience, anything which any intangible assets which with a 3 to 6 years or a 7-year life sails through. And again, we need to have logical reasoning as to why the economic life of a particular year has been considered. So let me give you one practical case that we are working on right now. We are valuing, we are doing a purchase price allocation for a business, and the business is a publishing house. In that case, usually these authors publish. So author writes the book, and we are the publishing house. So we publish the books, and there is not material changes in the books which is required for a period of 3 to 4 years, or maybe more than that. And I have come across many books where the first edition of that particular SKU is still being used and there is no relaunch of that book. And the first edition of the book, the sale also is kind of 20-25% of the overall revenue which the company is generating. In that case, we were internally debating as to what should be the economic life that we should consider when we are valuing this intangible asset. And when we were going through it, we came across that there is NEP guidelines which is going to be effective from 24 onwards, and that will require a major revamp of the books. So then we restricted our life to 2 years period when we were valuing that asset, considering that there is a law which requires that there will be change, and this product, basically the books, will have to be in a way revamped, though the concepts will remain the same, but there will be significant effort which will be required. And that is how we considered a lower life as compared to a 4 or a 5-year life, which is usually the case for this kind of for valuing this intangible asset. And The last part of it is the WACC, VARA, and IRR reconciliation. Now, many a times, and this is the toughest part of undertaking a PPA exercise. So usually we start with an IRR, determine what is the IRR rate for a business or for an equity share that has been acquired. You technically use the deal model. And when I say a deal model, one needs to take care that there are market participants assumptions which are there as part of the deal model. If there are deviations from a market participant's point of view, one needs to adjust. So let me give you a simple example. Let's say there is basically a relationship between a buyer and the wholly owned subsidiary, and the wholly owned subsidiary has given the asset on a lease basis at a rate which is not aligned with the market rate. So usually when we are analyzing the PFIs or the deal model, we need to ensure that the lease rents on the market are based on the market rate which is there or which is commensurate at that point in time. So one needs to be sure that the prospective financial information that we are relying on are from a market participant's point of view. Why is it important? Just think. So I'm sure everybody understands WACC, and WACC is usually derived through a CAPM model. If a IRR is more than a WACC, it may indicate that we have been able to acquire the asset, or I have got a sweeter deal basically, and there is a bargain purchase which is embedded in the price, or there can be specific synergies which are available to the acquirer and which are part of the PFI. So let's say a CFO function which may not be required once you acquire the business, and the deal model does not consider the salary of the CFO. Then that will tantamount that my cash flows are on the higher side and my IRR is higher than the WACC which is applicable to the business. If an IRR is lower than the WACC, it may happen that there is a conservative bias which is there, or there is an overpayment which I have made for acquiring that asset, or there are certain market synergies which I have not considered. So the reverse case where the lease rents are not at a market rate but at a higher than the market rate. In that situation will prevail where your IRR will be lower than the WACC. If IRR is equivalent to the WACC, it will indicate that the PFI is equivalent and it reflects the market participant's assumption, and the transaction is representative of its fair value. So it is quite intuitive. It's not counterintuitive. Think from it from that perspective that when you are buying an asset, the seller will try to recover an extra dime from you. You will try to negotiate harder and pay a lesser dime. So to a certain extent, you will be basically flexible to adjust the purchase consideration. But let's say if a deal is happening and it's an industry multiple is at an 8x or something, will the seller sell you at a 2x unless it's a distress situation? The answer to that is no. And that is the reason when we are saying that IRR and WACC and VARA. Again, what is VARA? We will come to it, but IRR has to be equivalent to the WACC. Usually a 5% difference is okay, or 5 to 10%. But again, if the difference is on a higher side, one needs to assess, go back to the drawing board and assess as to why your WACC is higher or VARA is higher. IRR is higher as compared to the WACC. What is a VARA? So VARA is a composition. So think of it from a WACC perspective. On the right side is the WACC. A WACC is a component of a debt and an equity, which is the cost of capital as to how you fund the business. And VARA is a composition of all the assets which are put to use. So from that perspective, if we look at it, the working capital is the least risky one, and which will have a required rate of return which is on the lowest of it, and which can be, and these are very quick assets, have a quick turnaround. Basically, you get debt funding on the higher side. And the next is the tangible assets. The tangible assets are hard assets again. You get debt funding, but these are not quick assets. You cannot turn around, or there is a liquidity issue with the tangible assets again. So the debt funding will be limited. The same way, the intangible assets will have a higher risk than the tangible assets and the net working capital. And the last one being the unidentifiable intangible assets, which comprises of goodwill or something. So the assets required return will move on the higher side towards intangible assets, and which is quite intuitive because the intangible assets will have the highest risk. So the risk and the reward ratio will have to be commensurate. Same way, when you are determining the WACC, the cost of equity will be on the higher side as compared to the cost of debt. So WACC is a decomposition or a dissection of a WACC will result into a VARA. VARA is nothing but a weighted average return expectation on all the assets which are employed in the business, which should be equivalent to the WACC. So coming to the last part, before I dwell into a case study, okay, I have then 15 minutes only to cover the case study, and then I leave the floor open. So while writing a PPA report, usually, and I just wanted to cover it because it is important for a practitioner to give a diligent report, because nowadays the peer reviews are happening for a valuation report which are being issued under IBBI, and it has to cover everything which is required. So you cover the background, we cover the scope and purpose, and I'll just rush through it so that we can spend some time on the case study. We also cover the financial overview, the historical financial overview of the company or the business that has been acquired, the sources and the procedures which are adopted, the basis to what is the valuation base and the premise. Usually a fair valuation base is required to be adopted because this is driven through an Ind AS 103. How we have identified the assets and the liabilities. So usually what we, and I have seen that many times practitioners will only describe the assets that they have valued, but they will not describe as to why the other assets have not been considered and what is the reason for excluding. Like let's say a simple example of a brand. A B2B brand might not carry a value also, but we mentioned that why it is in the assessment of the appraiser, why it does not carry a significant value, or why it is not being valued, though it has been assessed for the recognition, but it has not been valued. So that is something which we usually do. A goodwill that and why it is inseparable and all these things which we mentioned in the report. The valuation of the identified tangible assets exhibits we provide. And the last thing is the conclusion, where a PPA, executive summary of the PPA is provided with a sanity check of WACC, VARA and IRR, and the caveats and the scope limitations. Just one point over here to mention is that as per the guidelines which have been issued by the IBBI, the valuation report in terms of the RV, we cannot disclaim the work which is done by the other expert, and we should analyze the procedures and the formulas and the information which is provided and used by the expert to arrive at the value. So practically what we do is that we attach the tangible asset valuer report as part of our annexure only. And we also mention, not caveating it, but we mention that suitable procedures and has been adopted to determine or rely on the work of the expert. So with this, I will just quickly jump to the case study. Let me know if it is visible. Is it visible now?
Yes, sir.
Okay. So I'll overshoot maybe the session by 5 minutes or so, but this is really important and I want to cover this. Uh, so this is a practical case study that I thought we'll consider. And in this case study, we are acquiring, so Alpha has acquired a business of Beta, and the consideration is around 1,000 million. And the closing date is around 9th of May 2022. So the VAT is something which is given, that 13% is the VAT, cost of equity is around 15.7, and the applicable tax rate to the company is 25%. So as I mentioned, and they have given us the PFIs, the deal model. And the deal model goes like this, that the historical margins have also been in the range of 7 to 7.5%. And going forward, they are assuming that these margins will go up to 8% or so. Not getting much into as to how the projections have been built. The idea is to cover as to how a PPA exercise is done. And again, the depreciation, again, important point to note over here is that one needs to consider a depreciation on the fair value of the fixed asset and not the book value of the fixed asset. So if the fair value of the fixed asset has been, so fixed assets will be revalued at the time of acquisition, whatever is the fair value of the fixed asset, one needs to consider that. So this is the EBIT margins which are derived, and the capital expenditure has been provided. The first step is to determine what is the IRR. So for determining the IRR, what we do is we run a DCF, and these are numbers which are flowing again from that assumption sheet. You reduce the depreciation on the fair value of the fixed asset. I have considered 25% on the EBIT as the tax rate which is applicable. The capital expenditure has been considered as assumed, and the working capital at the rate of 25% is given. So you discount the cash flows, and we usually consider a midpoint to discount the cash flows. You determine what is the business enterprise value. My purchase consideration was 1,000. In this 1,000, there was a pass-through item. Pass-through item is what we usually call is a cash or a net debt. So here the cash is positive, and 250 million of cash is going to be transferred. So technically, my business enterprise value is around 750 million. So an important point just I wanted to mention over here is that you have to consider a depreciation on the fair value of the tangible assets to determine what is the IRR. So IRR is nothing but a goal-seek function as to at what rate of discount my value will be equivalent to 1,000 million. So the rate that is determined over here is 13.3% or so. Okay, just coming to, so let's say we are valuing 3 intangible assets. One is the brand, customer relationship, and the non-compete arrangements. So I'll cover brand first. And in the brand, so let's assume it's a B2B brand. It's not a intangible of prime importance. Otherwise, for a asset which is of prime importance or utmost importance, a multi-period excess earning method is used. A brand here being a B2B, we have considered a RFR method. Now what happens is that these are the revenues, these are the cash flow streams which are projected, and these are nothing but coming from the assumption sheet or the IRR sheet, as you may put it. Now the revenue attributable to the brand, it will go down as the brand in number of years, because the life of the brand will be limited. So we are not trying to say that the brand will not be there post 5 years. So here we have considered in this example a life of 5 years, but there will be a significant reduction on the revenue from this brand, and there will be other brands that will be replacing this brand overall. Unless, let's say, if I was valuing a Whips bread, then technically I would have considered a higher life, because the Vips bread, as people would have recall that, or let's say a Lux soap or an HUL brand, it will have a longevity which is there, and one may also consider an indefinite life. But uh, again, when you are considering indefinite life, please be sure that whether these brands have a longevity or not. Otherwise, the valuation numbers and will be thrown as erroneous. The revenue which will be attributable to the brand will have a linear uh, diminution in terms of the dependency on the brand, and that is the reason that out of the revenue of in 27 of 204 crores, only 30% is attributable to the brand, and the rest is attributable to the other brand which will be there as part of the product portfolio. We have considered a royalty rate of 1.5%. So here the brand maintenance cost, if one has to do a brand maintenance cost like an advertising, so if I was valuing an FMCG brand and which was a B2C, the royalty rate would be on a much higher side, and the brand maintenance cost of advertising or something which would have, or a selling and marketing spend would be considered. Over here, this is not required, so I have considered 0%. The idea of putting this is that so that the viewers are aware as to usually this is a kind of adjustment which one needs to be mindful of. You reduce the tax which is applicable, and on a PV term, you determine the value of the brand. Now, how do you calculate a tax amortization benefit? Now, to determine a TAB benefit, this is the so it's a simple thing. What is the present value of the cost savings or the amortization benefit, which is nothing but a 100 rupee asset will have a 16 rupees of a cost saving, which will equivalent to 19.7% on a present value terms. So this is something which has been added to the value of the brand. So 46 million is the value of the brand. On that, 19.7% is added, and to determine the fair value of brand as 55 million. Coming to non-compete agreements. So here we have considered a with and a without method. And again, the life has been restricted to 5 years just for the ease to show as to how the model works. So the revenue from operations remains the same with the deal IRR model. Here there is a stub period of 10 months and some 10.7 months or so, and that is the reason that 31st March is a stub period that has been considered. The EBITDA margins is considered the similar. As I mentioned, that capital expenditure, working capital, everything will remain the same in the with as well as the without model. The point to note over here is one needs to determine what will be the loss in revenue due to competition. So what will happen that in the first year, when there is a competition with the existing seller, there will be a higher loss in revenue, but it will taper down because we will intuitively what will happen is that we will also understand the business, we will understand the customers. There will be marketing spends which will be done by us in order to compete with the erstwhile promoter, and that is the reason that the loss in the revenue will taper down. And at the end of the life, maybe it can go down to zero or it will be very negligible. And that is how usually non-compete agreements are framed. That till the time you feel that you do not have a visibility that you will be able to control the business, you enter into a non-compete agreement with the erstwhile seller of the business. So here, so this is again a subjective assumption which is considered by the appraiser. And this is usually through discussions with the management, understanding as to what will be the kind of impact that the other party will bring on the table. So I'm just explaining you the first year as to what happens. So my adjusted revenue, there is a loss of 30%. So technically only 70% of the revenue of 1250 will be there for the first year. Of that, I have considered EBITDA margin of whatever is the EBITDA margin with the with model. In the incremental marketing cost, because I have to withstand the competition, And to restrict it to, let's say, 30%, I will have to incur certain additional marketing expenses also. Now, usually we look at the historical trend and determine this number, but in the paucity of time, let's assume that this is 0.5%. So my adjusted EBITDA margin will be around 7%, which is 7.5 less 0.5, and my EBITDA will be 61 million or so. The depreciation number remains the same. As I mentioned earlier, we have to assume everything remains the same because other tangible assets and intangible assets are there as is various basis. You arrive at the differential cash flows or the incremental cash flows within the period. You discount this at a commensurate risk adjusted rate of return. You add the tab and you determine the value of the non-compete arrangement. Now, here I have not applied a probability of competition, but the probability of competition one can always assume based on the qualitative factors of the ability and the willingness of the promoter to compete. Coming to the customer relationship, so here the customer relationship is being valued, and this being of prime importance has been valued using a multi-period excess earning method, which is MEM or an MP method. The life which we have considered here is 7 years. So what we have done in this example is that in the first year, whatever are the customers that is there, so 1250 is the revenue. The total revenue belongs to the existing customers. Of that, there will be a churn which will be happening. And this churn rate, as I mentioned, is through an attrition factor, which we determine. Many a times, the businesses are so tricky and the relationship does not have a usual trend. Then we are also in a fix, and I don't have a correct answer to guide you as to how do we solve for that problem. But it is usually through discussions and the technical literature that one has to go through to determine what should be the attrition rate. So here we have taken a life of 7 years and 15% as the attrition rate. We take an average attrition rate year on year as to what will happen. So 86% will go down by 15% in the next year, again 15%, and we take the average. So the revenue which is attributable to the acquired customers on day 0 will have a declining trend. And the EBITDA margins are equivalent to the margins which are generated by the business. The depreciation and is adjusted overall prorated based on the revenues, and there is an expense adjustment of 0.75%. So in my assumption, what we usually do is that the selling and the marketing expenses which we do as a company, these are in the is for the existing as well as onboarding new clients in the business. And here the ratio is something which I have given in the example of 25 to 75. So that 75% expense on the marketing spend is towards the onboarding of the new customers. What we are trying to value is the relationship with the existing customers. So my EBIT margin has to be adjusted for 75 basis point of the revenue, which is an expense to be incurred to acquire the new customer, but does not belong to the existing customer. So I add that expense back to arrive at the adjusted EBIT margin, reduce the income tax. How do we calculate the contributory asset charge? Now, this is a little bit important, and I'll spend 5 minutes as to why do we, how do we calculate the contributory asset charge. I've already explained you the concept behind the contributory asset charge, and I'll repeat once again that these contributory asset charge are towards the assets of tangible working capital, workforce, and other intangible assets, which play an important role to generate 7.5% of my EBITDA margin. So all the assets are put to use to generate 7.5%. We are trying to value the customer relationship or the cash flows attributable to customer relationship. And for that, we reduce the charge towards the fixed assets and the other assets, which is there. So how do we do that? A contributory asset charge is usually a levelized charge which is applied for a particular period or life of the intangible assets. Now, how do we determine the levelized charge? So we take the fair value of the fixed asset and we determine what is the closing balance of the fixed asset at the end of the year. And we run it for maybe 25 years or so for a long-term period. And we estimate what should be the commensurate adjusted risk or a return expectation on a fixed asset. So over here, I have considered a debt and an equity funding of 40 and 60 with a cost of debt of 7% and then cost of equity of 15.8% or so. So I determine a weighted average return for fixed asset of 12.3%. This is discounted at 12. So the return is on 119 for a particular period, which is 13.1. Since it's a stub period, it is prorated. What is the CAC, which is a contributory asset charge on the revenue? This you do it for 25 years, and on a present value terms, you determine what should be the CAC as a percentage of revenue, which is again applied on a adjusted revenue of 1166. Same way for a working capital. A working capital, as the business grows, the working capital amount which will be required to be parked in the business will grow. So you take the average balance which is required to be parked as working capital. You assume a rate of return, and this rate of return here has been determined using a debt of 60%. As I mentioned that these are more liquid assets, have a quick turnaround, and hence the debt funding is usually higher as compared to the fixed asset. So the rate of return that we have considered is 10.6%. You again do the same on 324 at 10.6%. What should be the return expectation? And as a percentage of revenue, what should be for a particular year? And you determine on a levelized basis and you adjust this. Just in the paucity of time, same way do it for brand as well as non-compete. But just here, one thing to note is that for a brand, you usually, though the life has been taken as 5 years, you don't restrict to the charge only for 5 years. You take it for whatever is the life. The reason being that, as I mentioned, that this particular brand has a life of 5 years, but there will be certain other brand which will be replaced, and that will always have a bearing on the earnings capability of the business. For a non-compete, we restrict the charge to a contractual life of, in our case, it was 5 years. So we restrict it to 5 years because this is a non-recurring event technically for a business to be valued. You reduce that, you determine the free cash flows attributable, you do a present value, you add the tab, and you arrive at the fair value of the customer relationship. So let's see how my summary stacks up. So what happens is that there is a WACC, VARA, and IRR analysis which I explained has to be done. Now what will happen is that here my total purchase consideration is 1,000. Out of that, there are cash and cash equivalents of 250 which are passed through. My business enterprise value is 750. Out of 750, 420 in terms of the fair value belongs to tangible as well as working capital requirement, which is equivalent to 56% of my purchase consideration. You do a weighted average return on the assets. For a relationship, brand, and non-compete, you determine what should be the estimated rate of return. So here we considered the cost of equity plus 0.5%. Usually practitioners also take WACC plus some premium to it or a CSRP to it, basically to determine what should be the rate of return. And for goodwill, a little bit on a higher side where a premium of 1% is considered. So we arrive at a VARA of 13.4%, WACC of 13, and IRR of 13.3%. So in this example, everything is matching, but trust me, when you are trying to do it for the first time in any assignment, you will not be in a position to match. So it's an iterative process which one needs to do and try and determine that the difference between VAC, VARA and IRR is not material. If it is material, then one needs to go back to the drawing board and assess whether it's a bargain purchase or are we missing on the finer details of it. With this, over to you, the moderator. I'm through with my presentation. Sorry, I was shorted by 5 minutes or so and I have to rush some slides.
No problem, sir. Thank you so much for your words and detailed knowledge about PPA. So we have few questions. So I have forwarded that to you. Can you please check your chat box and let's see how much time allows. Let's solve the questions which we'll be able to solve within the time allowed.
So first is, if I acquire IP, will it be a business combination? If you acquire IP as a particular asset, it will not be a business combination. Do we need a PPA exercise when we acquire an interest in associate at the higher value than the relative stake in the net assets of the acquiree? Interest in associates is a specific carve out from Ind AS 103. Sorry, I have not understood this question, but if the question you are asking is whether an interest in associate requires a PPA, the answer to that is no. If base price is 5 crore and acquired transaction expense is 1 lakh, which has been paid, such that the fund flow statement says, no, again 5 crores. Okay, sorry. The question is, if the base price is 5 crores and the acquired transaction expense is 1 lakh rupees, which has been paid by the acquirer, such that the fund flow statement states that 4.99 crores is transferred to the acquiree, what will be the PC in this case? It will be 5 crores, basically, which needs to be done. I have observed that the next question is, hello sir, I have observed that the assembled workforce is calculated and reported in PPA reports. If assembled workforce is not an intangible asset as per Ind AS, do we need to report it in case MEAM as a method is not used for valuation of intangible? Sorry, I'm not clear with the question, but what I could understand is that assembled workforce is calculated and reported in the PPA reports. It is reported, but it is usually reported separately, or it usually forms part of the goodwill. If assembled workforce is not an intangible asset as per Ind AS, do we need to report it? It is not required to be reported. Just for the purpose of calculation of CAC in the MEAM, you need to consider this as a contributory asset charge. If you are not using MEAM, there is no requirement to value assembled workforce again. But if you are valuing any other intangible, and let's say if there is only one intangible, my first preference will be to use a MEAM method rather than an RFR method, I would say. So technically, I would value assembled workforce in that case also. How can we? So I'm coming to the next question. Hope I have answered that. How can we evaluate the value of leases where we made significant improvements? Example, we have taken a place on lease and we have made improvements there and offer it to use for event purpose. Now we are transferring the lease to another person. How can we evaluate the value of such premise? But that will be forming part of your rental this thing only. So it's technically, what I understand, it's between a furnished and an unfurnished property which you are providing on lease. So there will be a difference in the rate, the lease rent only, because let's take a simple example. When a property is available with fit out and without fit out. So for a fit out, there will be separate charges that you will charge. So coming to the next question, how contingent consideration will be accounted for in case of an asset acquisition? Contingent consideration should not be accounted in case of an asset acquisition. Contingent consideration is only equivalent to while determining the PC. For determining the value of an intangible asset, it does not play any role. What is contributory asset charge? As I explained, contributory asset charge is the charge which is required to be deducted to determine the So when you are valuing a company, there are tangible as well as intangible assets which play an important role. When you are determining a valuation of an intangible assets like a relationship, you need to remove all the margins which will be attributed, or a return expectation of the other tangible and intangible assets which will be put to play. So that is the way of doing this, and this is done through determining a contributory asset chart. Now, in PPA, do we consider carried forward losses benefit? For valuing an intangible asset, the answer is no. But for doing an IRR, if it is available with the asset, we do consider this. It's an interesting question. Thank you for asking this. Do we consider a carried forward losses? And why do we consider the carried forward losses? Because it's a asset specific loss which is available with any of the acquirer. So for calculating the IRR, we consider this, but in terms of valuing a brand or a customer relationship, we do not consider this carry forward losses. How will the goodwill be treated for impairment in the subsequent year if the company has followed proportionate method to value the non-controlling interest? Well, it will be considered again on a proportionate basis. So you have to determine the value of the total company, attribute the value of the goodwill, and then determine on a proportionate basis. Ayushi, any other questions which are there, or any follow-up questions which we have received on this?
Questions are this much till now as per time allows to us as well, sir. And I hope these questions are also clear to all the participants who have raised these queries and to others as well. So thank you so much, sir, for all your knowledge and guidance. Hoping for much more knowledge from your side in further future webinars. And thank you, participants, for being so cooperative and motivating us to just conduct these kinds of webinars every Sunday. Bhavik sir has also shared the ID through which you can contact him or raise any other queries if you have. So
I'm happy to help. So I have posted my ID and my official ID. If there is any query which I have not been able to address, and if somebody wants to touch base one-on-one, happy to help.
Yeah, thank you
so much, Ayushi.
And I request all the participants to please fill the feedback form that is displayed on your webcast screen. It would help us to improve and bring you better services. Thank you so much. Happy Sunday, everyone.
Thank you.
See you next time. Bye.
Thank you, everyone. Thanks, Valuation Standard Board, for this.
Thank you, sir.
Bye.
Recording stopped.